We're now on to day 3 in the 14-day course. Today's module is market terminology, and we are simply translating the Forex market terminology whilst keeping it super simple. Now, today's game plan, we will be covering simplifying exchange rates, followed by pips and pipettes, and finally calculating profit. Now, as always, before we head into today's module, I just want to review what we learned in day 2. So we learned that currencies can either be bought or sold to make profit. So you can trade either end of the market, and these are trading what is known as currency pairs. Now, these currency pairs are divided into 3 categories, such as major, cross, and exotic. And of course, we as traders at Six Figure Capital, we focus on major and cross currency pairs. Exotic currency pairs, I would recommend to then focus on them once you're a profitable trader. For more experienced traders, you can then start looking at exotics. We also learned that the Forex market is broken up into 4 major trading sessions, which include Sydney, Tokyo, London, and New York. So let's head into our first module for today, our first topic, I should say, which is simplifying exchange rates. You may have noticed in yesterday's module, I mentioned exchange rates. Today, I'm going to be breaking those down so it makes perfect sense. So currency pairs, or most currency pairs I should say, are quoted to 5 decimal places. For example, Great Britain pound US dollar would be quoted at 1.40000. So after the decimal point, you have 5 figures. We have Euro US dollar at 1.20000, so we've got 4 zeros following the 2. However, Japanese yen pairs, JPY pairs, are quoted to 3 decimal places. So this is the exception. We have Great Britain pound Japanese yen at 160.000, so we can see that there are 3 numbers that follow the decimal point. And another example, we have US dollar Japanese yen at 120.000. Now remember, the currency on the left hand side is the base currency, and the currency on the right is the quoted currency. So again, Great Britain pound US dollar at 1.40000. This would mean that the Great Britain pound is worth 1.4 US dollars. And again, Great Britain pound Japanese yen at 160, you get the gist. It would be 160 Japanese yen. So let's put this into a trading perspective. Let's break it down even further for you. You buy Great Britain pound US dollar on the trading charts on your trading platform as you expect the price to increase. So Great Britain pound US dollar was trading at 1.4, but is now trading at 1.41. You would have made profit as the exchange rate has increased. So of course, if you're buying and the exchange rate increases, you make profit. And on the flip side, let's say you sold, so you sell Great Britain pound US dollar as you expect the price to decrease. Great Britain pound US dollar was trading at 1.41, but is now trading back at 1.4. Again, you would have made profit as the exchange rate decreased. So again, if you're selling and the value decreases, the exchange rate decreases, you make profit. Now let's head into our second topic for today. Our first topic was very short and sweet. It was simply just laying the groundwork for exchange rates. There's not much to drag out there. So our second topic for today is pips and pipettes. So a pip is a unit of measurement which expresses the difference in exchange rate between 2 currencies. So this is how we measure the exchange rate. Simply, it is used to indicate how much the exchange rate of a currency pair has moved within any given time period. So don't worry, I will go over this in more detail, but I want you to calculate them manually. This is not a bad habit to develop. If you get into the habit of calculating pips manually, it will make your trading so much easier instead of having to use calculators all the time. And as I've just said, this is a good habit to develop. Do not get lazy. So here we have an example of a Japanese yen exchange rate. Let's say, for instance, it is Great Britain pound Japanese yen. The second decimal place is the most significant, and this is 1 pip. So we have what's known as a pipette, which is the smallest amount of the exchange rate, the smallest calculations. We have 1 pipette, which is a tenth of a pip. We have 1 pip, and then we have 10 pips, and so on. So you always work from right to left. So the far right will always be a pipette. Then you'll have 1 pip, 10 pips, and then so on, 100 pips, 1,000 pips, 10,000 pips. On to another example here. Great Britain pound Japanese yen was trading at 160 but increased to 160.010. There's a lot of zeros here, just keep track. This is counted as 1 pip. So you can see here the exchange rate moved from 160.000 increased to 160.010. Now work out these examples below. So you've got 160.000 to 160.100. What would this be? It would be 10 pips. The price has moved 10 pips. Now this example, 160.000 to 161.000. What would this be? It would be 100 pips. So if you got those right, brilliant. If not, don't worry, you've got plenty of time to take this in. Simply, pips mean profit. That is all you need to know. Pips simply mean profit. It allows us to calculate how far an exchange rate has moved. So the more pips that we gain, the more profit we're going to make. So all we want is to make some pips. Here we have an example of a standard exchange rate, a 5 decimal place exchange rate. This could be Great Britain pound US dollar, for example. So in this situation, the 4th decimal place is the most significant, equaling 1 pip. So again, starting from the right hand side, we have 1 pipette. So at the far right is always 1 pipette. This is a 10th of a pip. Then we have 1 full pip, which is the 4th decimal place. In the previous example, of course, it was the 2nd decimal place that was the most significant. So this one is the 4th decimal place that is the most significant. Then we have 10 pips and so on. 100 pips, 1,000 pips, 10,000 pips. So let's say Great Britain pound US dollar was trading at 1.4 but increased to 1.40015. This is counted as 1.5 pips. Of course, because you've got the pipettes, so you've got 5 pipettes and 1 full pip. So this is counted as 1.5 pips. Now, I want you to work out these examples below as well. So we have 1.4 to 1.40500. So this would be 50 pips. And again, 1.4 to 1.41. And this would be 100 pips. As always, this is a saying that I live by. KISS. Keep it super simple. Don't overcomplicate anything. This is a very simple subject. If you just listen to exactly what I'm saying and just take it in as it comes, don't overcomplicate it. If you don't get it, go back over this section. You can go back over pips and pipettes again. You will get it. It's a very simple topic to understand. And once you actually get onto the charts, it will make perfect sense. So as mentioned, get into the habit of calculating these changes manually. Get into the habit of calculating how much an exchange rate has moved in pips. Because once you go into the charts, this will prove extremely useful. Now moving on to our final topic for today, which is calculating profit. Now the Forex market and stock market, as we know, they have their similarities. If you trade stocks, you're buying and selling shares of a company. Whereas if you're trading Forex, you're buying and selling shares of a currency. Now, those shares that we are buying are known as units or lots. And this is what we use, and this is what helps us calculate how much profit we will make. So the units or lots that we use determine the value of your trading position. So how much you could potentially make, as in the profit, or how much you could potentially lose. So when placing a trade through your broker, you will set a specific unit or lot size. Don't worry, this will come in later modules towards the end of the 14-day course. You will select a specific unit or lot size in alignment with your risk management strategy. Now this is typically a small amount of risk, 1 to 2% of your entire account. Again, we will cover all this later on in the 14-day course. Now currencies are bought and sold in the minimum bulk of 1,000 units or 0.01 lots, which equals 10 pence a pip, or this might be 10 cents a pip, depending on your local currency. The more units or lots you are using to trade a currency pair, the greater the value of the pip. Meaning, the more you can potentially make, and the more you can potentially lose. So the bigger the units or lots, the bigger the profits. But also on the flip side, the bigger the losses. We always use a unit or lot size that reflects our overall account balance. So as I mentioned previously, this is typically 1 to 2% of your entire account balance. But again, as mentioned, we will cover all this later on in the course. This way we can properly manage risk, and protect our capital. Because the last thing I want is anyone blowing their accounts and putting themselves at major risk and losing all of their capital. So here we have an example of unit sizes and their value. So when you come to trade on your brokerage platform, on the trading platform, you will have to set either a unit or a lot. So we'll cover units and lots. So here we have units and their value. So 1,000 units is equivalent to 10 pence a pip, or 10 cents. 2,000 units is 20 pence. And all the way down to 100,000 units, which is £10 a pip. So typically, most of you coming in will be trading 1,000 units or 10,000 units for the most part. Most of you will be trading the minimum amount, and I would recommend that when you're starting out. Start out trading the lowest amount and then build up from there. Here we have lot sizes and their value. So lots and units, pretty much the exact same thing, but just represented in a different way. Here we have 0.01 lots is equal to 10 pence a pip. So you can see that 1,000 units is the same as 0.01 lots. We have 0.10 lots, which is £1 a pip or $1 a pip. And then all the way down to the bottom, we have one full trading lot, which is £10 a pip. Now, lot sizes and their value, they have certain categories. So the category for 1,000 units or 0.01 lots is what's known as a micro unit or a micro lot. So your micro lots would go from 0.01 all the way up to 0.09, and as soon as it hits 0.10, it is then considered a mini lot or a mini unit size. Again, this would go from 0.1 to 0.9, and then it becomes a full standard lot size, which would be £10 a pip or $10 a pip. Now, unit size determines the value per pip, if you haven't realized that already. And the magic formula that we use is very, very simple. You take the unit and lot size times by the pips gained or lost. So 10,000 units on a currency pair that has moved 100 pips in your favor, that would be £1 times 100. So let's say you're trading with 100,000 units, not lots, that would be a lot of lots. If you're trading with 100,000 units, which is £10 or $10 a pip, and you obviously took a trade that was successful and you made 100 pips, so the exchange rate moved 100 pips, you would times $10 by 100 pips. So you would have made, of course, you would have made $1,000 or £1,000. So unit sizes can go much higher than 100,000. These are just the typical unit sizes that most people will be starting off with. Even working up to one full lot, that's a very big lot size to be trading with. £10 a pip is a big size to be trading with. Institutional traders, such as hedge fund traders, will use unit sizes above 10 million units, which is the equivalent to $1,000 or £1,000 a pip. So these are the guys that are trading with big money. Now onto our rookie mistake for today, number 3. Again, these are real trading mistakes that cost me a lot of time and a lot of money. So these are what not to do. And this rookie mistake for today is overdoing it. A very simple rookie mistake that you can make. You're now getting into the more complicated aspects of trading. You're learning, of course, which means you're learning the terminology, the more technical aspects of trading, which means you can also become extremely overwhelmed. And this is the only advice I can give you. Keep it super simple. If you get overwhelmed at any point, just pause, relax, go back, and redo the topic, redo the module. Okay, don't just trooper on and try to complete the 14-day course because you need to do it within 14 days. I'd much rather you understood everything I was telling you than get to the end of the course and 50% of the information is completely misunderstood. So take your time with the course. There is no time limit to complete. If you don't understand the topic, go back and redo it. So as I said, keep it super simple. And I love this quote by Woody Guthrie. It's amazing. Any fool can make something complicated. It takes a genius to make it simple. And it really just comes down to that. So let's just wrap up for today. Again, another successful module. As mentioned, the base currency is always on the left. The quoted currency is on the right. So currency are quoted at either 5 or 3 decimal places, such as 1.44500, which would be a Great Britain pound US dollar exchange rate, or we have a Great Britain pound Japanese yen exchange rate, which would be 160.500. Always work from right to left to calculate pips and pipettes. It's always easiest doing that. You know that the far right is 1 pipette, then 1 pip, 10 pips, 100 pips, and so on. So we use units and lots to calculate our position sizes, and we will elaborate on that further on in the course towards day 14, towards the end of the course, possibly day 12 as well. And we know that the bigger the units, the bigger the profits. But also on the flip side, the bigger the losses. Which also means, and as I've just said, the bigger the losses. So if you're using more lots or more units, you can make a lot more profit. But again, your losses will be bigger. So this is why we need to make sure that we stay within our risk portfolio. We're not putting our capital at too much risk. We're sticking to the 1 to 2% risk per trade. That way, we can ensure long-term growth. So in tomorrow's module, which is day 4, You Are the Trader, we will be covering identifying your trading personality, followed by 3 types of analysis. So things are starting to get really interesting here. And finally, trading journal. I'd just like to thank you guys for joining us on day 3, and I'll see you tomorrow for our next module.